Joining us now to share his commentary on the day's markets picture is Vik Sharma from Differential Capital. Vik, thanks so much for your time this afternoon. Let's start off with what we heard out from Jerome Powell last Friday. It does seem like he's turning dovish, somewhat indicating higher chances of a rate cut come next month. Does this shift the needle for you in terms of your expectations, or would you rather take a wait-and-see approach? Because there are still some of those data prints that will come out before the meeting by the Fed.
Yeah, thanks, Dowling. Thanks for having me on the show. I think, clearly in terms of, J. Powell being dovish, that was, quite a good writing on the wall for the markets. For us as well, I mean, I think it kind of, the pressure that he has been under, and he's been actually quite a hawk. What he actually presented at Jackson Hole just is a very relief outcome, if you want to say that. And to us, I mean, it does look like it does pave a little bit of a way for the US markets to ease the rates,
Yeah.
which is in fact potentially good news for all the EM markets, for all the markets globally, that money probably might come into US system a little bit more. So when rates are being cut, I mean, I think the saying is cash is trash. So essentially, you would want to be invested a little bit more. And I think you can kind of see that wild optimism, if you want to call it, in the short term, but essentially could pave way for, let's call it, some good markets eventually down the line.
And with, expectations or bets rising for a rate cut come September by the Fed, does that open the door for another cut from the SOB, perhaps?
Yeah, I mean, I think clearly, we as South Africa are quite good at following what is happening in international trends. I think there is no doubt about that. And essentially the headroom that is given by one of the biggest economy in the world does put you in a good stead to obviously cut rates here as well. I think inflation here is also quite low, even though we are obviously targeting a little bit of a lower band. But you're absolutely right. I mean, I think EMs do get headroom for the real rates to go down.
All right, let's take a look at what's playing out on the company news front. Results season really picking up here at home. And let's kick things off with Sasol. The group really in recovery mode with profits ticking higher. We are seeing a recovery there from a loss to an annual profit. It's also making way with its strategic initiatives in, this tough operating environment. Markets seem to be loving the numbers. The last time I checked, that share price was up over 9%. Are you starting to buy into this turnaround plan, Vik?
Yeah, I mean, I think the issue is obviously, they're talking about their free cash flow being much higher,
Yeah.
even though there is a one-off from Transnet. Overall, the guidance for the next year on the operational matters seems to be on the positive side, right? As everyone knows that, oil price has been actually sinking a little bit year over year. Even the outlook for oil price isn't that good, and that's the macro part of it. But looks like whatever is under control of the management team, they seem to be doing quite a good job at it. So, yes, even if you remove that one-off free cash flow, I think the management was indicating at the call, free cash flow was up about 30%. But in a down year, you're at least maintaining that free cash flow.
Yeah.
So that gives market a little bit of confidence. So like I say, the guidance is quite good. And third thing I wanted to highlight was, this Chinese anti-involution policy, which is basically kind of saying that they're going to control the competition, potentially could revive the chemical markets globally, and where the pricing could actually surprise on the upside.
Yeah.
And market potentially could be reading positive news through it, probably over the course of last 2-3 weeks.
All right. On the other side of things, we have Tile posting a 2% rise in HIPS. Is this one of those counters that really depends on a stable economy for it to sustainably grow, Vik?
Yeah, I mean, I think it's basically your discretionary income, right? And even in discretion, I would say, these are the things potentially or projects which you can defer if you wanted to,
Yeah.
right? I normally call South African consumer as what I call as, instant gratification, which they get from buying that extra shirt or an extra dress from discretionary retail. I think these things, because they can be deferred, possibly are on the back burner because of the pressure on your discretionary income of the consumer. But eventually, you have to think of, inflation is much lower, oil is much lower. There could be hope for them. Like I said, I think the last time as well, 6 to 12 months down the line, when consumer is in a much better shape.
And talking about the consumer and I guess spending habits, while shoppers spend less on renovation, what they are paying for and paying more for is private education. This evident in, of course, Advitech's latest numbers, increased enrollments, leading to a jump in both revenue and profit. What did you make of those results, Vik?
Yeah, I think Advotech, like you said, I think strength to strength, right? Not just in South Africa, even
Yep.
in rest of Africa, and they made an acquisition there as well. Enrollments are taking in the right direction. I think education tends to be very defensive when it comes to
Yes.
consumer expenditure because you don't want your kid not to go to a school, right? And essentially, that's why those spends do continue. And Advotech probably is in the slightly better cohort of consumer who aren't actually feeling as much pain, if you want to call it that.
Okay.
Because if you actually compare it to someone like a Curo didn't see as good enrollment numbers as Advotech has. So it does look like they've actually been in that cohort, which is a lot more defensive in its education spending. And I think, yeah, kudos to company in terms of, kind of diversifying away into rest of SA and still doing a phenomenal job of, pretty much still finding out opportunities with new schools there. I think it is definitely a counter for the longer term, yeah.
All right, let's hit pause on the conversation. Before we move on to your stock pick, let's take a moment to touch on what counters your industry peers are watching closely.
My stock pick is Morningstar, the US company that provides data and analytics, particularly to the financial services sector, and they rate managers. They do a lot of analytics in terms of research on stocks. And I believe that it's derated quite meaningfully in the last 5 years, similar to other players in the space. But it's got quite a resilient business model. They've got recurring revenue in their business, so there is certainly going to be continuation. It's unlikely that the fund managers would cut out, or the advisors would cut out their source of data to make decisions. So they might also benefit from AI helping them with data analytics. So it might improve their performance rather than other companies that are threatened by AI.
I'm not betting any money on anything else but just short term. I think the US tech is just very overvalued, and the one overvalued counter I'm looking at is Palantir. And essentially what I'm doing is taking a 125 put option September expiry. I think that essentially when you break the price up into all the risks, the delta, gamma, and row risk, I think you can take a bit of volatility from that stock just purely because it sits on such a high valuation, almost 1,000 times sales. The PE is north of 3,000 times. If you had to tell that even to a university student, they'll tell you that's very overvalued. So short-term trade, I'm taking $125 put option September expiry on Palantir.
So a short-term trade on Palantir and a bet on Morningstar. What are your views on those counters?
I think Palantir one is obviously, as your guest kind of clearly mentioned, the valuation metrics, if you just look at them in isolation, it does make absolute sense of not owning something which is at like 1,000 times price to sales. That said, I think there is a paradigm shift story behind it. There is an issue of Europe spending a lot more money on rearming itself, and potentially Palantir could be a beneficiary. Not that I have looked at it in very much detail. I think I would probably be in his camp, just looking at the inflation, in the valuation numbers. But eventually there is a lot more than what meets the eye.
Yeah.
But in the short term, possibly he's right, because tech is under pressure. It's kind of an overvalued stock, so you potentially could benefit from it. Morningstar, quite an interesting pick because it has actually been derating for the last 5 years. Possibly found some kind of base, still trades at higher multiple. You cannot live without these companies. I think he was right in that sense. essentially you need their services. I think could there be growth in their services or not? I think that's still a writing on the wall. It's that active versus passive debate.
Yeah.
Do you need those active managers, and do you need all those kind of data to give to those active managers, or money is still moving passive? I think that is still to be solved before you get very, very positive on those things.
All right, so then let's get your stock pick. Where are you seeing opportunity at the moment?
Yeah, I mean, I think I look at more local, let's call it unloved stocks. Supergroup is the one, which essentially has sold its Australian operations. They're bringing some money back. They've got money, some operations in UK which aren't doing quite well. And even if I look at those UK operations and value them at zero, I think their South African operations are technically undervalued. They have dealership businesses. They have, your supply chain businesses in Africa, and supply chain is not easy in Africa. I mean, there have been enough examples where companies have actually went into Africa and kind of not made money. So to me, I mean, I think from a perspective of it's trading at 6.5 times earnings, forward earnings. I mean, they've just reported 6 months. I'm just doubling that with a 5% dividend yield. And to me, I mean, I think for the returns that these underlying businesses generate, even if I assume that your UK businesses are zero, you'll still probably undervaluing the business. And not to mention, the management team has shown the path that they actually can degrow or kind of make the business smaller by selling stuff. So essentially, if they were to sell some more stuff, you could actually see the surprises coming out from there.
All right, let's leave it there. Vik, thanks so much for your time and just taking us through trade at midday. That was Vik Sharma from Differential Capital.